For more on the markets, we turn to Brian Jacobsen, Allspring Global Investments Senior Investment Strategist. That's right, 4 Scaramucci's if you missed that, Brian. Let me just quickly start over there in the UK. Is it going to make our equity markets a safe haven, or will we feel that pain eventually?
I think that we are going to see some of that pain, but it's more in the strength of the dollar. And we're already hearing about that from corporate America. Actually, this began, I think, with Microsoft even back in March when they were talking about how a stronger dollar was likely going to be weighing on their revenue growth. So the U.S. is still a safe haven, but being a safe haven doesn't mean that there isn't some cost associated with that. The stronger dollar likely to be a headwind going forward for a lot of corporate America. And it's also been a bit of a headwind for U.S. investors overseas. So here at Allspring on my multi-asset team, when we're looking at the global landscape, something we have to consider is the outlook for the currencies. And so if you've been a U.S.-based investor investing in the U.K., it's been a double whammy. You've got the declining markets and then also their currency depreciating as well.
Brian, let's talk about, focus here on the U.S. and specifically today. Once again, we're looking at all 3 of the major averages trading to the downside after we got more hawkish comments from the Fed. The Fed's Harker saying that he expects rates to be, quote, well above 4% by the end of the year. It clearly doesn't seem like we're out of the woods yet. I'm curious, just from your perspective, what your view of the downside risk is from here.
Yeah, so we actually think that we might be this isn't really a cop-out trying to answer it, but kind of a choppy bottom here, right? We've had a significant decline with the S&P 500 already. We think that we are likely going to go into a recession in the first part of 2023, and markets typically begin rebounding. The median is around about 4 months before a recession ends. So if we do get a rather short-lived recession, we think that we could get a decent recovery in 2023. So between now and then, we think it's actually more of a micro as opposed to a macro story. And by that, I mean, talking to Anne Maletti, our head of fundamental equities, she has said that, eventually every storm runs out of rain. And we have to ask ourselves, well, kind of with Creedence Clearwater Revival, the song, right, who will stop the rain? Well, sometimes it's the companies as far as how well they're running their businesses. But then for the bigger picture, the macro environment, it's really the Fed. It's the Fed speak. So until they actually get close to the 4.5%, what we think is their terminal rate, we think that we're still in for these ups and downs.
Speaking my language, no way Seana caught the CCR reference.
I didn't.
Wow, okay, I just wanted to be clear.
I didn't.
No way, but Brian, I am with you.
Dave to call me out on it too. I was trying to fly under the radar there, but go ahead.
I'm with you on the CCR though. That is some legendary stuff. So until then, how do we position ourselves, Brian?
Yeah, so until then, the way that we're doing things on our systematic edge multi-asset team is trying to take a little bit more defensive positioning, but still trying to participate in the upside. So allocating more to active managers like Anne Maletti and the fundamental equity team there. And then as far as with doing the individual security selection on the fixed income side, because we think that there's actually a tremendous amount of value that can be derived from doing the sifting and winnowing between the winners and the losers. Who is it that's going to be positioned for gathering market share here while everybody else seems to be struggling? But then from that broader kind of asset allocation perspective, consumer staples, it's one of our favorite places, a little bit more defensive. They already got battered down in the first quarter, especially with the inventory overbuild that a lot of them have. We think that they're working through those issues. But then investment grade fixed income. So kind of that consumer staples for some defensiveness, but participation in the equity markets. And then doing the investment grade analysis on the fixed income side to generate some of that coupon income.
Brian, when you're trying to figure out what's going to lead us higher, a catalyst that's going to make it stick, other than inflation, other than the Fed pulling back, anything else that you think could really push equities substantially higher from here?
Yeah, so I was actually talking to our head of risk analytics the other day. We were recording a podcast, kind of a spooky podcast about the things that to be afraid of in the markets for Halloween. And we were talking a lot about geopolitics, right? So Russia, Ukraine, that's a big wild card. How is that going to play out and when? Because, it's kind of this binary outcome. It's going to be a deep, dark winter and a rather difficult recession for Europe, unless, of course, there is some sort of breakthrough with the Russia-Ukraine situation. And then it could actually be off to the races as far as a significant revaluation with European equity markets. So some of the geopolitical issues could really be that big catalyst. But otherwise, day to day, it really feels like it is the Fed speak. What did Harker mean when he said significantly higher than 4%? If they could operationally define these terms, I think it would give a lot of investors a little bit more clarity that we're all seeking.
Yeah, one more CCR reference. Long as I can see the light would be a good one for this moment here. Are you seeing that light thus far in the earnings reports?
So far, yes. And thankfully, that light coming at you is not a train barreling down at you. It actually does look like it's the sun coming out a little bit, or at least it's the fact that some of these businesses, right, they are able to navigate this environment. And I think that's an incredibly important thing for investors to remember, is that businesses are operated by managers and employees that can adapt to a changing environment, right? So we shouldn't just assume that the way that they operated in the 80s or the 90s is the way that they operate today. They're going to be dynamic. And that's one of the big reasons why we focus a lot on understanding corporate governance. So in terms of the E, S, and G for ESG investing, all of those are incredibly important. And right now, it's really those that have the good corporate governance and good management that seem to be really exceeding the expectations.
Brian Jacobsen, always great to have you. Thanks so much for joining us today.